Well, it's time now for business, and for that I'm joined in the studio by Stephen Carroll. Hi, Stephen.
Hi, Hagsy.
You're starting with a warning from the airline industry about transporting a COVID-19 vaccine. That is, of course, once one is hopefully produced.
That's right. The International Air Transport Association says it will take thousands of jumbo jets to ship a vaccine around the world. The organisation, which represents 290 airlines, says it'll be the biggest transport challenge ever for the air cargo industry. Along with the Vaccines Alliance, Gavi, they're calling on governments to start legal and technical preparations now. This as airlines have dramatically reduced their flight networks during the pandemic and put planes into storage because of the downturn in passenger travel, and that's curtailed the capacity for air cargo as well.
Now, Facebook is facing a new inquiry into how it handles European users' personal information and data.
That's right. Ireland's data regulator has begun an inquiry into the movement of data to the United States by the social network. This follows an EU court ruling in July, which struck down the so-called Privacy Shield arrangement, whereby data transfers from the EU to the US were deemed to be legal. This is the first move by a European regulator to enforce that decision. The Irish Data Protection Commissioner sent Facebook a preliminary order to suspend sending information on European users to the United States and has sought the company's response.
And Stephen, next to the latest on the French government's plans to get big digital companies to pay more tax.
Including, of course, Facebook as one of those that would be subject to this tax. France wants a formal European Union proposal for a digital tax to be made by March of next year. That's as Paris fears the United States will block the currently stalled talks at the OECD on the issue. A previous proposal for an EU-wide levy on digital revenues failed to secure the unanimous agreement of member states. France is one of several European countries who have announced their own tax in the meantime, provoking threats of retaliatory tariffs from Washington.
Next to a mega merger in the luxury goods sector that's very much on the rocks.
The French giant LVMH says it's no longer in a position to buy the iconic American jeweler Tiffany. The $16 billion deal was agreed before the pandemic struck. Now Tiffany is suing LVMH for not completing the deal. The owner of Louis Vuitton says it's acting on advice from the French government. Luke Schrager reports.
Did the French government just torpedo the biggest deal the luxury goods industry has ever seen? Not according to government sources. They say a letter sent to luxury leviathan LVMH asking it to defer acquisition of US jeweler Tiffany & Company for $16 billion was in no way binding. Rather, Paris was apparently seeking breathing room to assess the fallout from potential new tariffs from Washington, mostly on the luxury sector.
In a context of international negotiation, that is very significant. With our partners, the French government is neither naive nor passive. We have goals that we want to achieve. There's a current discussion with a certain number of partners, especially the United States.
The US has threatened to slap 100% tariffs on $2.4 billion of French products in response to moves there to establish a tax on global tech giants, something that has for now been postponed until December after the US presidential election. LVMH has insisted the letter was legal and valid, leaving the conglomerate no choice but to further defer an already delayed closing past November or walk away. However, it comes against a backdrop of a luxury sector stricken by coronavirus and evaporating consumer spending. Tiffany saw successive losses in the first and second quarters of 45% and 29% respectively. Its share price has been trading $10 below the $135 LVMH agreed it would pay last year, leaving some asking if it wasn't overpaying for the US company. Tiffany, for its part, is pushing forward and is taking LVMH to court to get the deal through.
After huge falls in technology shares in recent days, Wall Street saw the first signs of a bounce back on Wednesday. The tech-heavy Nasdaq index on Wall Street finished up over 2%. That's after having slumped by 10% over the previous 3 trading days. The sell-off sparked by investor fears that those big tech giants were overvalued after having gained significantly during the pandemic. The S&P 500, the broader index of shares on Wall Street, having its best day in 3 months. Positive trends carrying over into what's happening on the Asian markets today. The Nikkei in Tokyo up by just under 1%. Gains across the board there. The Kospi in Seoul up over 1%. Some market analysts worry, though, that this bounce may not last.
Is really just sort of a reflex rally. The S&P 500 fell 7% in only 3 trading days. And I think that it just went too far too fast. So we're seeing a bit of short covering, in my opinion, reflex rally. But the real question is, what do the markets do on Thursday and Friday of this week?
And finally, from you, the bank JP Morgan has fired a number of its employees after they apparently got money from the government's COVID fund.
That's right. The Financial Times says that several employees have lost their jobs after it emerged they had improperly applied for and received money from the American government's Business Rescue Fund. The Economic Injury Disaster Loan Scheme has been giving grants and loans to firms that were hurt by the pandemic. The JP Morgan workers that got the money weren't using their position at the bank to do so, but it does go against the lender's code of conduct. It was discovered when the staff deposited apparently suspicious funds in their bank accounts.
Well, naughty bankers. Stephen Carroll with the Business News, thank you very much.